Change comes in many forms, but the most unstoppable one is age. Aging brings its own challenges, physical, mental, but most importantly, financial. Still, many of us spend very little time planning or saving for it. Now, I'm not going to repeat the same old arguments about how our kids or the government won't take care of us. Maybe they will, maybe they won't. But the whole point of retirement planning is to have enough to support ourselves and be able to live life on our own terms, free of any dependencies when the income from a regular job stops. And the best part, you don't have to wait until your 60s to get there. So in this 3-video series about retirement, we will try to find answers to some important questions. How much do we need to retire? How do we plan for it? And when we should ideally retire. So let's get started. If you're new here, my name is Srijit, and on this channel, we talk about travel, wealth and happiness. Now, I'm not a financial advisor. I'm just a random guy on the internet talking about my experiences. So do your research before you act on any of the things I say here. Before we get into the actual calculations, it's important to take a moment to understand the term retirement, because retirement doesn't have to mean we stop working. At least that's not my idea of retirement. For me, it simply means that I have the financial means to live comfortably whether I choose to work or not. In simple terms, retirement is the moment when I can stop working for money. And the first step to getting there is figuring out how much is enough. And it's not enough to simply say a lot of money. You need to zero in on an amount, because if you aim for too large a number, you may have to make some unnecessary sacrifices in your lifestyle, and saving too little is of course not an option. And this number is not going to be the same for everyone. There are many factors that come into play here, like cost of living, healthcare, lifestyle, number of dependents, and many more. But luckily, there exists a common formula to calculate the minimum amount you need for retirement, also called the survival threshold. And there are two important factors to consider here: your annual cost of living and your lifespan. Let's take a look at each factor in detail. The annual cost of living is the amount you need per year to cover basic expenses like food and rent after retirement. And here, it's important to account for lifestyle changes that happen after retirement. Maybe you will travel more, or start a new hobby, or even launch a business, all of which come with additional cost. At the same time, expenses related to transportation, dining out, and clothing may be significantly lower, since you no longer have to go to the office every day. The more accurately you can estimate this, the better. And for the sake of simplicity, I'm not considering any retirement income for now. Now, the second key factor is life expectancy, or the number of years you expect to live after retirement. No one can predict exactly how long they will live, but this is one factor that continues to rise. So if you retire at 60, it's reasonable to plan to cover at least 30 years of expenses. However, there is a catch when we consider such a long duration. The price of a loaf of bread or a movie ticket is not going to be the same in 10 or 20 years. There is something that reduces the purchasing power of money over time.
The soaring inflation.
Inflation to be extraordinarily elevated.
Prices continued to rise in September.
And this rate at which price increase, or the rate of inflation, depends on where you live. For example, let's say your annual expense at retirement is $35,000. If inflation is 2% per year, your expenses will rise from $35,000 to $35,700 in the second year, and so on. So considering this, how much would our total expenses be over 30 years? There is a mathematical formula that helps with this. Target value equal to present value into 1 plus rate of return raised to number of years minus 1 divided by rate of return. The formula itself may seem complicated, but you can easily calculate it in ChatGPT or use my retirement planner to do the math for you. Now, applying the numbers, a yearly expense of $35,000 and a 2% inflation rate, the total expense over 30 years would be approximately $1.4 million. This is a huge number, but luckily we have two powerful tools to help us here: investment and compounding. When we build a retirement fund, we are not simply storing cash under our bed. We invest our savings that grow over time while still providing us with income during retirement. Let's say you start retirement with $150,000 invested in a portfolio that grows at an average annual rate of 6%. Even if you withdraw $50,000 in the first year, your balance won't just drop to $100,000. Instead, thanks to the 6% growth, your portfolio will be around $106,000 by the end of the year. This means that you will only need less than the initially calculated $1.4 million in your retirement fund, because even as you withdraw money, the remaining balance continues continues to generate returns. Now, considering all these factors, how much do we need to save? There are many complicated formulas to calculate this, but I have designed a template in Notion to do all this complex work. So, assuming $35,000 annual expenses after retirement, a 30-year retirement period, a 6% investment growth rate, and 2% inflation, you would need to have around $600,000 in your retirement fund by the time you retire. Now, this calculation assumes that you have no other savings, but that wouldn't probably be the case. So, in the second step, list down all your assets and liabilities. Assets are everything you own. Money in the bank, retirement accounts, investments, everything goes in here. Liabilities or debts include all financial obligations you have, like student loans, mortgages, and unpaid bills. And finally, calculate your net worth by simply subtracting your total assets from your total liabilities. Now, adjust your calculated retirement corpus by adding or reducing your net worth. The more you already have, the less you need to save, and the more you owe, the more you need to make. Now, these are not exact figures. You need to adjust these values, such as your expenses, inflation rate, and investment return rate based on your lifestyle, where you live, and where you invest. There are too many factors that can change along the way. While we cannot predict the future, what we can do is use the information available today to make smarter financial decisions. If you're interested, I've created a retirement planner to help you with all these calculations. All you have to do is enter some key details like your personal data, such as current age, desired retirement age, and expected lifespan, economic indicators such as investment returns and inflation rate, and finally financial data like annual expenses, current savings, assets, liabilities, and any expected annual income after retirement. With all this data, the template will calculate exactly how much you need in your retirement corpus and how much you need to invest each month to get there. It's completely free to use, and you can find the link in the description below. In the second part of the series, we will discuss different strategies and approaches that we can use to save for retirement. So do subscribe to the channel and turn on notifications. Until I see you again, have a wonderful rest of the day and adios.